A tax is a compulsory payment levied by the government on individuals or companies to meet the expenditure which is required for public welfare. Government collects tax revenue by way of direct taxes and indirect taxes. In this module, we will study about the direct taxes in detail. A direct tax is the one in which the ultimate burden falls on the person on whom it is levied. The burden cannot be shifted from the original payer to someone else. These taxes are based on the principle of ability to pay and are progressive in nature. They thus reduce income inequalities and bring about adequate social and economic justice. In case of direct taxes, the payers know how much is due from them and when. The authorities also know the amount of revenue they can expect. Thus, in case of direct taxes, the tax evasion can be minimized. However, despite these merits of the direct taxes, there are certain demerits too. For instance, if tax burden is high, people's consumption level gets adversely affected, and this has an impact on their ability to work and save. High taxes also discourage people from working harder in order to earn and save more. Reduction in savings results in low investments. The low investments thus depress the capital formation and production. We will discuss these merits and demerits in detail in this module. In addition to this, we will also discuss two types of direct taxes, the income tax and the corporation tax, and the trend they follow over the years.
After studying this module, you shall be able to define direct taxes and their merits and demerits, understand the trends in major direct taxes in India, understand the reforms undertaken in direct taxes in India, analyze the reforms undertaken in direct taxes in India. The revenue raised by the government through various taxes is known as tax revenue. Government collects tax revenue by way of direct and indirect taxes. A direct tax is one in which the ultimate burden falls on the person on whom it is levied. The burden cannot be shifted from the original payer to someone else, and he has to pay the tax directly to the government, like income tax and corporation tax. Let us now discuss the merits of direct taxes. Principle of equity. Direct taxes are based on the principle of ability to pay and are progressive in nature. Principle of certainty. In case of direct taxes, both the players and government are aware about the amount that is due and that is to be collected. This certainty minimizes corruption and tax evasion, creates civic consciousness. Direct taxes make people more responsible as they know that the public spending is because of the amount paid by them as tax. Elastic, with an increase in expenditures or deficits, the government can increase the revenues from direct taxes by increasing the rates of taxation. Productive, as an economy prospers, the revenue from direct taxes expands automatically. We will discuss demerits of direct taxes. These are large-scale tax evasion due to high tax rates, corruption, complex documentations, etc. Narrow coverage. Agriculture sector and large informal sector does not maintain balances and thus are exempted from taxes. Affects capital formation. If tax burden is high, consumption and saving level is affected and reduction in savings reduces investments and thus depress the capital formation in the country. Let us now observe the trends in direct taxes in India. As we can see in the table in the 80s, the direct tax as a percentage to GDP had decreased from 1.27% in 1980-81 to 1.18% in 1990-91. The share of direct taxes in total taxes had reduced from 20.23% in 1980-81 to 16.06% in 1990-91. However, after the economic reforms of 1991, direct taxes as a percent of GDP have shown an improvement. It improved from 1.18% in 1990-91 to 2.29% in 2000-2001 and further to 4.09% in 2010-11. Direct taxes as a percentage of total tax collections rose from 16.06% in 1990-91 to 36.33% in 2000-2001 and 55.01% in 2010-11. The factors responsible for the decline in share of direct taxes were large agricultural sector of subsistence nature, small-scale industrial activities, lack of monetization in accounting practices, low levels of income, scaling down rates of direct taxes, plethora of exemptions and concessions, abolition of estate duty in 1985, large-scale tax evasion. Factors that led to the improvement in direct tax collections are expansion in the tax base, extension of the base for tax deduction at source, improvement in direct tax administration, high tax compliance due to restructuring of tax administration, and introduction of information technology on a large scale.
Income tax in India includes all income except the agricultural income. Income tax is levied and collected by the central government. Personal income tax is administered by the Central Board of Direct Taxes under the Ministry of Finance in accordance with the provisions of the Income Tax Act 1961. It is an annual tax on income of both individuals and companies levied by the Union Government. Any person whose total income exceeds the maximum exemption limit is chargeable to the income tax at the rates prescribed in the Finance Act passed each year by the Parliament. The income tax is paid on the total income of an individual determined on the basis of his or her residential status in India. An individual is considered a resident if he or she stays for the prescribed period during a fiscal year, that is the 1st of April to 31st of March next year, either for 182 days or more, or 60 days or more, or 182 days or more for non-resident, and has been in India in aggregate for at least 365 days in the previous 4 years. Any person who does not satisfy these norms is considered as a non-resident. A tax is charged in respect of the income of the previous year, that is the financial year beginning from 1st of April and ending on 31st of March, and the same is chargeable in the assessment year, that is the next financial year.
Now we will discuss different major direct taxes. Let us start with personal income tax. Personal income tax is an annual tax on income of both individuals and companies levied by the Union government. Every person whose total income exceeds the maximum exemption limit is chargeable to the income tax at the rates prescribed in the Finance Act passed each year by the Parliament. The income tax is paid on the total income of an individual, determined on the basis of his residential status in India. The heads included in the taxable income are salaries, income from house property determined by reference to the annual value of property, profits and gains of business or profession, capital gains, income from other sources.
Personal income tax is an important source of direct tax revenue in India. The tax rate in personal income taxes were exorbitantly high by any standards during the decades of the 80s. The need for rationalization of tax structure was felt long back before the economic reforms took place during the 90s. The relative contribution of personal income tax have been declining over the years. It came down to 2.91% in 1990-91 As a percentage of the GDP, the personal income tax shows a decline from 0.29% in 1980-81 to 0.21% in 1990-91. The reasons of this decline were less tax evasion and slowdown of the economy during this period. The tax structure of the personal income tax has been rationalized to a large extent since the initiation of the tax reforms. After the tax reforms were initiated in 1991, the percentage share of the income tax in the total tax collection has increased.
Let us now look at the trend of personal income tax. In 1980-81, personal income tax accounted for 4.68% of total tax collections. However, the relative contribution declined over the years and it came down to 2.91% in 1990-91. As a percentage of GDP, the personal income tax shows a decline from 0.29% in 1980-81 to 0.21% in 1990-91. The reasons were tax evasion and avoidance and due to slowdown of the economy. After the tax reforms initiated in 1991, the percentage share of personal income tax went up to 17.39% in 2000-2001. Till 2007-8, the share kept increasing. Thereafter, it fluctuated slightly and was 17.97% in 2010-11. The increase in 2000s was moderate due to the slowdown of the economy post-global financial crisis. The percentage of personal income tax on GDP has increased from 0.21% in 1990-91 to 1.10% in 2000-2001 and then 1.33% in 2010-11. Foreign nationals working in India are generally taxed only on their Indian income. Income received from sources outside India is not taxable unless it is received in India. The Indian tax laws provide for exemption of tax on certain kinds of income earned for services rendered in India. Further, foreign nationals have the option of being taxed under the tax treaties that India may have signed with their country of residence. Remuneration for work done in India is taxable irrespective of the place of receipt. Taxable payments include all allowances and tax equalization payments unless specifically excluded. Component of direct taxes is corporate tax. Corporate taxes are annual taxes payable on the income of a body corporate operating in India. The provisions relating to corporate income tax are contained in the Income Tax Act 1961. Corporate tax is the tax charged on the profits earned by associations and companies by several jurisdictions. The rate of corporate tax in India depends on whether the profits have been passed on to the shareholders or not. Companies residing in India are taxed on their worldwide income arising from all sources in accordance with the provisions of the Income Tax Act. Non-resident corporations are essentially taxed on the income earned from a business connection in India or from other Indian sources.
For the purpose of taxation, companies in India are broadly classified into domestic companies and foreign companies, or in other words, resident or non resident companies. Depending on their residence, they are subject to different tax treatment. Companies that are registered in India according to the Companies Act 1956 are deemed to be domestic companies, or a company whose chief control and management are wholly located within India is also known as domestic company. A domestic company may be a public company or a private company. A company which is not registered in India, or if its management control is exercised from a foreign country, then it is treated as a foreign company or non-resident company.
In India, according to the Companies Act of 1956, are deemed to be domestic companies, and a company whose chief control and management is wholly located within India is also known as a domestic company. A domestic or resident company is taxed on any income which is received or is deemed to be received in India in the relevant previous year by or on behalf of such company, any income which accrues or arises or is deemed to accrue or arise in India during the relevant previous year, any income which accrues or arises outside India during the relevant previous year. A company which is not registered in India, and if its management control is exercised from a foreign country, then it is treated as a foreign company. A foreign or non-resident company is taxed on any income which is received or is deemed to be received in India during the relevant previous year by or on behalf of such company, any income which accrues or arises or is deemed to accrue or arise to it in India during the relevant previous year. This table shows the corporate tax rates levied on the domestic companies and foreign companies. Domestic company with total income exceeding rupees 10 million are taxed 32.45% and company with total income less than rupees 10 million are taxed 30.9%. Foreign company with total income exceeding rupees 10 million are taxed 42.24% and company with total income less than rupees 10 million are taxed 41.2%. Let us now look at the trends of corporate taxes over the years. In 1980-81, corporate tax was 14.01% of the total tax collected, while in 1990-91 it was 12.41%. As a percentage of GDP, corporate tax was 0.88% in 1980-81 and it went up to 0.91% in 1990-91. The reason for a slow growth in 80s was slowdown of the economy. Post 1991 reforms, there was an improvement in the revenues from corporate taxes. The share of corporation tax in total revenue increased to 18.42% in 2000-2001 from 12.41% in 1990-91. Thereafter, it rose to 36.70% in 2010-11. The revenue from the corporation tax grew at the fastest rate during the 90s. As a ratio of GDP, the revenue from the tax increased by 3 times from 0.91% in 1990-91 to 2.72% in 2010-11. This happened in spite of reduction in the rates. The increasing profitability of the Indian corporate sector is reflected in the growth of the ratio.
During the 80s, there was an improvement in the government's tax collections due to comprehensive tax reforms implemented in 1985. The corporate tax rate was cut, the income taxes were simplified and lowered for high income groups. The number of tax brackets were reduced from 8 to 4 and the highest income tax rates were brought down to 50%. The tax reforms initiated since 1991 were a part of the structural reforms process after the 1991 economic crisis. The Tax Reforms Committee under Professor Raja J. Chalaiya was appointed by the Government of India in 1991 to lay out a suitable framework to reform both the direct and indirect tax structures. It aimed to rationalize the direct tax structure and increase compliance by taking steps in the following directions: reducing the rates of individual and corporate income taxes and making it more progressive, broadening the tax base, reducing exemptions and concessions, computerization and improvement in the quality of tax administration, introduction of permanent account number to track monetary transactions. The tax rates were considerably simplified to have three slabs beginning with a rate of 20%, 30% and 40% in 1992-93, which were later reduced to 10%, 20% and 30% in 1997-98 and have continued to be so till date, with some changes in the associate tax brackets. The exemption limit remained at Rs 50,000 since 1998-99, but in 2005-6 budget, it was raised to rupees 1 lakh. In 2011-12, the exemption limit was increased to 1,80,000. The surrender deduction was abolished. In addition, the savings in the superannuating schemes up to rupees 1 lakh was made deductible from the taxable income. In case of corporate taxation, the distinction between closely held and widely held companies was done away with, and the tax rates were unified at 40% in 1993-94. In 1997-98, the company rate was brought down to 35%. In 2005-06 budget, the corporate income tax was reduced to 30% to domestic companies with a surcharge of 10%. A major problem with the tax system was the generous tax preferences. These preferences evolved a set of zero tax companies which was sought to be eliminated by introducing the minimum alternative tax in 1997-98. Minimum alternative tax uses a separate set of rules to calculate taxable income after deductions. Preferential deductions are added back, and then the AMT exemption is subtracted to get the minimum alternative tax taxable income. A fringe benefits tax was introduced in 2005-06 to tax the indirect benefits of a wide range of expenses of the company, including entertainment, conference, employee welfare, sales promotion, including publicity, conveyance, tour and travel, including foreign travel expenses, and the use of telephone. The most important reform in the tax administration was an expansion of the scope of tax deduction at source. It was one of the significant measures to reach the hard to tax groups. In simple terms, TDS is the amount of tax getting deducted from the person, say an employee, by the person paying, for instance, an employer. It was made mandatory for every individual living in large cities covered under any one of the 6 conditions: ownership of the house, cars, membership of a club, ownership of the credit card, foreign travel, and the subscriber of a telephone connection to file a tax return. Nationwide Tax Information Network on behalf of the Income Tax Department was designed to make the tax administration effective. Filing of tax returns convenient, reduce compliance cost, and bring greater transparency. The new Direct Tax Code is set to replace the existing Income Tax Act of 1961 in India. The DTC bill was tabled in Parliament on 30th August 2010. Direct Tax Code is expected to widen the tax base, give moderate relief to taxpayers, reduce unnecessary exemptions, and improve compliance, thus improve collections. It also seeks to address new realities like operations of foreign companies in Indian markets, foreign institutional investors, and cross-border mergers and acquisitions. Let us now recapitulate what we have studied in this module. A direct tax is the one in which ultimate burden falls on the person on whom it is levied. In the 80s, the direct tax as a percentage of the gross domestic product had increased from 1.27% in 1980-81 to 1.18% in 1990-91. The reasons were largely agricultural sector, the lack of monetization and accounting practices, low levels of incomes, large number of exemptions and concessions, and large-scale tax evasion. However, after the economic reforms of 1991, direct taxes as a percent of the GDP have shown an improvement. It improved from 1.18% in 1990-91 to 2.29% in 2000-2001 and further to 4.07% in 2010-11. The improvement in direct tax collections during this period could be attributed to expansion in the tax base, extension of the base for tax deduction at source, and improvement in the direct tax administration. In 1980-81, as a percentage of the GDP, the personal income tax shows a decline from 0.29% in 1980-81 to 0.21% in 1990-91. The percentage of the personal income tax on GDP has increased from 0.21% in 1990-91 to 1.10% in 2000-2001 and then 1.33% in 2010-11 post 1991 reforms. As a percentage of the GDP, the corporation tax was 0.88% in 1980-81 and it went to 0.9% in 1990-91. The reason for a slow growth in 80s was slowdown of the economy. Post 1991 reforms, there was an improvement in the revenues from corporate taxes. As a ratio of the GDP, the revenue from these tax increased by 3 times from 0.91% in 1990-91 to 2.27% in 2010-11. This happened in spite of the reduction in the rates. The increasing profitability of the Indian corporate sector is reflected in the growth of the ratio. The trends in the personal income and corporation tax show that reforms have a favorable impact on the growth of the direct taxes. The reforms in tax structure have resulted in better compliance of taxes.
Let us now summarize what we have learned in this module. A direct tax is one in which the ultimate burden falls on the person on whom it is levied. After the economic reforms of 1991, direct taxes as a percent of GDP have shown an improvement. The improvement in direct tax collections during this period could be attributed to expansion in the tax base, extension of the base for tax deduction at source, and improvement in direct tax administration. Both corporate tax and personal income tax as a percentage of GDP showed a decline and slower growth respectively before the 1991 reforms. Post the reforms, there was an improvement in the revenues collected from both the taxes. The trends in personal income and corporation tax show that reforms have a favorable impact on the growth of direct taxes. The reforms in tax structure have resulted in better compliance of taxes.